Okay, you've got the CRR cut has come down from 4.5 to 4.25%. Now this is not going to nudge the market needle because the CRR cut of 25 bips, well, according to me, was well baked in. Do we have a repo rate cut? That is more important. Do we have something when it comes to rate cut? George, CRR cut, but do we have a repo rate cut?
No, we don't. So no surprises over there, Nikunj. Quarter percentage point cut on the CRR, which essentially returns 17,500 crore rupees to the banking system, which is something that the banks were expecting. On the repo rate front, no change, so it remains at 8%. The positive really coming out from here is that the RBI has said that while inflation is expected to rise in the current quarter, that's Q3, by Q4 they see the inflation rate declining. And in the fourth quarter, they have said that there is a reasonable likelihood of the RBI taking a softer stance on policy rates, essentially sending out a signal that if anyone was expecting policy rate action in the third quarter, possibly in the December quarter by way of a repo rate cut, that's quite likely not happening. But in January and in the March mid-quarter review, you could possibly see some repo rate action. That's a clear message coming out from the Reserve Bank of India. So a hugely, maybe not dovish, but a significantly less hawkish stance the RBI has taken on monetary policy. Now, on the projection front, it has revised a number of its projections. So GDP growth, which was pegged at 6.5% in its earlier review, has now been scaled down to 5.8%. This is, if you go back to yesterday's macroeconomic development report, they were talking about a number of 5.7%, which was the professional forecaster survey. So the RBI projection is at 5.8%. Inflation has been revised upwards from 7% to 7.5%. Credit growth has been scaled down from 17% to 16%. Deposit growth has been scaled down from 16% to 15%. But going forward, the money supply... Okay, so let's go across to the governor who's making his statement on the policy.
Of scheduled banks by 25 basis points from 4.5% to 4.25% of their net demand and time liabilities, NDTL, effective the fortnight beginning November 3, 2012. The reduction in the CRR will inject around 175 billion rupees of primary liquidity into the banking system. There is no change in the policy interest rate. Accordingly, the repo rate under the liquidity adjustment facility remains at 8%. Consequently, the reverse repo rate under liquidity adjustment facility, determined with a spread of 100 basis points below the repo rate, will continue at 7%. And the marginal standing facility, MSF rate, determined with a spread of 100 basis points above the repo rate, will remain at 9%. What's the rationale behind this policy action? Let me explain that. The decision to cut the CRR and keep the policy interest rate unchanged draws from our assessment of the evolving liquidity situation and the growth inflation dynamic. First, on liquidity, systemic liquidity deficit has been high because of several factors. The wedge between deposit and credit growth, the buildup of government's cash balances from mid-September, and the drainage of liquidity on account of festival-related step-up in currency demand. This high systemic deficit will have adverse implications for the flow of credit to productive sectors and for the overall growth of the economy going forward. As regards to growth inflation balance, headline WPI inflation moderated from its peak of 10.9% in April 2010 to an average rate of 7.5% over the period January-August 2012. During this time, growth has slowed and is currently below trend. This slowdown is due to a host of factors, including monetary tightening. Since April this year, the Reserve Bank's monetary policy stance has sought to balance the growth inflation dynamic through calibrated easing. The transmission of these policy impulses through the economy is still underway. In conjunction with the fiscal and other measures recently announced by the government, the Reserve Bank's monetary policy should work towards arresting the loss of growth momentum over the next few months. Yesterday's statement by the Finance Minister, reaffirming commitment to fiscal consolidation, will open up space for monetary policy to restrain inflation and support growth. Now coming to inflation, it turned up again in September, reflecting the partial pass-through of adjustment of diesel and electricity prices and elevated inflation in non-food manufactured products. It's therefore critical that even as the monetary policy stance shifts towards further addressing growth risks, the objective of containing inflation and anchoring inflation expectations is not de-emphasized. The policy document spells out the three broad contours of a monetary policy stance. These are, first, to manage liquidity to ensure adequate flow of credit to the productive sectors of the economy. Second, to reinforce the positive impact of government policy actions on growth as inflation risks moderate. And third, to maintain an interest rate environment to contain inflation and anchor inflation expectations. As in the past, we've also given guidance for the period forward. By reducing the CRR, the Reserve Bank intends to preempt a prospective tightening of liquidity conditions, thereby keeping liquidity comfortable and supportive of growth. The policy stance anticipates the projected inflation trajectory, which indicates a rise in inflation over the next few months before easing in the last quarter of this fiscal year. While there are risks to this trajectory, the baseline scenario suggests a reasonable likelihood of further policy easing in the fourth quarter of this fiscal year. Let me add, though, that this guidance will, however, be conditioned by the evolving growth inflation dynamic. We expect that today's policy actions and the guidance we have given will result in the following three outcomes. First, liquidity conditions will facilitate a turnaround in credit growth to productive sectors so as to support growth. Second, as inflation risks moderate, the growth stimulus of the policy actions announced by the government will be reinforced. And finally, the policy action will anchor medium-term inflation expectations on the basis of a credible commitment to low and stable inflation. As always, our policy action has been based on a careful assessment of the global and domestic macroeconomic situation. Let me comment first on the global economy. Over the last quarter, policymakers around the world have confronted increasingly difficult challenges. Globally, even as the growth momentum has slowed, governments have had to manage the balance between fiscal consolidation and growth stimulus, amidst visible signs that the two objectives are in conflict with each other. As the advanced economies deal with these tensions and global demand conditions weaken, emerging and developing economies are also slowing down. Liquidity infusions by central banks in advanced economies during the quarter have contributed to some stability in global financial markets. It's important to note, though, that liquidity infusions are only a stopgap measure intended to maintain financial stability and arrest further downturn. They cannot substitute for robust structural solutions that can return the advanced economies to the path of recovery. At this stage, growth risks have risen and could well overwhelm the positive effects of enhanced liquidity. Moreover, notwithstanding some muted softening recently, commodity prices are still at elevated levels. Consequently, there is a significant risk of liquidity-driven price increases. Even as the recovery process moves forward, the months ahead will be a period of heightened uncertainty for the global economy. Let me now turn to the domestic macroeconomic situation. Growth decelerated over 4 successive quarters, from 9.2% year-on-year in the fourth quarter of the year before to 5.3% in the fourth quarter of last year. In the first quarter of this year, growth was marginally higher at 5.5%. This slight improvement in the output growth in the first quarter was mainly driven by growth in construction and supported by better than expected growth in agriculture. On the demand side, the growth of gross fixed capital formation decelerated, while the slowdown in growth of private consumption expenditure continued. The external demand conditions and crude oil prices also remain unfavorable, adversely impacting net exports. Over the last quarter, global risks have increased and domestic risks have become accentuated owing to halted investment demand, moderation in consumption spending, and continued erosion in export competitiveness, accompanied by weakening business and consumer confidence. The industrial outlook remains uncertain. Notwithstanding the improvement in rainfall in the months of August and September, the first advance estimates of the 2012 Kharif production are about 10% lower than last year's production. On the basis of the above considerations, the baseline projection of GDP growth for 2012-13 is revised downwards from 6.5% to 5.8%. Excuse me. Moving on to inflation, headline WPI inflation remains sticky at about 7.5% on a year-on-year basis through the first half of the current year. Furthermore, in September, there was a pickup in the momentum of headline inflation owing to the increase in fuel prices and elevated price levels of non-food manufactured products. This is in part attributable to some suppressed inflation in the form of early underpricing being corrected. However, even after adjusting for this, the momentum remains firm. Non-food manufactured products inflation was persistent at 5.6% through July-September. This upside pressure was a result of firm prices of metal products and other inputs and intermediates, especially goods with high import content due to a depreciating rupee. Consumer price inflation, as measured by the new CPI, remained elevated, reflecting the build-up of food price pressures. Looking ahead, the path of inflation will be shaped by two sets of counteracting forces. On the downside, slower growth and excess capacity in some sectors will help moderate core inflation. Stable, or in the best case scenario, declining commodity prices will reinforce this tendency. An appreciating rupee will also help to contain inflationary pressures by bringing down the rupee cost of imports, especially of commodities. Balancing those downside forces are some on the upside. Persistent supply constraints may aggravate as demand revives, resulting in price pressures. Global financial instability could put downward pressure on the rupee, and that too will add to imported inflation. Also, the upsurge in both rural and urban wages will exert cost push pressures on inflation. Finally, as underpricing in several products is corrected as part of the fiscal consolidation process, suppressed inflation is being brought into the open. This correction is necessary and important. Nevertheless, it will result in higher inflation readings. Taking the above factors into consideration, the baseline projection for headline WPI inflation for March 2013 is raised to 7.5%, up from 7% indicated in July. Importantly, inflation is expected to rise somewhat in the third quarter before beginning to ease in the fourth quarter. Liquidity conditions, as reflected in the average net borrowing under the LAF, at 486 billion rupees during July-September, remained within the comfort zone of ±1% of NDTL. However, liquidity conditions tightened in October, mainly on account of the build-up in the government's cash balances and the seasonal increase in currency demand, taking the average LAF borrowing to 871 billion rupees during October 15-25. This was well above the band of ±1% of NDTL. Now let me highlight the risks to our growth and inflation projections. First, the downside risks to growth stemming from the global macroeconomic environment now seem likely to be stronger than earlier thought. Domestically, a revival in investment activity, which is key to stimulating growth, depends particularly on the recent policy announcements by the government being translated into effective actions. Second, despite recent moderation, global commodity prices remain high. Also, under-recoveries in domestic prices of administered petroleum products persist and will need to be corrected. While corrections are welcome from the viewpoint of overall macroeconomic stability, we have to guard against the second-round effects on inflation. Third, the behavior of food inflation will depend on the supply response in respect of commodities characterized by structural imbalances, particularly protein items. Fourth, the persistent increase in rural and urban wages, unaccompanied by commensurate productivity increase, has been and will continue to be a source of inflation pressure. Fifth, the large twin deficits, the current account deficit and the fiscal deficit, pose significant risks to both growth and macroeconomic stability. And finally, while liquidity pressures pose risks to credit availability for productive purposes and could adversely affect overall investment, excess liquidity could aggravate inflation risks. This review also includes developmental and regulatory policies which focus on carrying forward the initiatives taken for strengthening the financial system and for efficiently providing financial services to the widest sections of society. Let me briefly indicate some of the important initiatives in this regard. I will begin with initiatives for financial inclusion, credit delivery, and customer service. Drawing on extensive consultation with banks, we have rationalized the guidelines on priority sector lending. Important initiatives in this regard are the following. Loans up to 20 million rupees to partnership firms, cooperatives, and corporates directly engaged in agriculture and allied activities. Under partnership, rural cooperative, and corporate categories will also be classified as direct finance to agriculture. Bank loans to housing finance companies, HFCs, for on-lending for housing up to 1 million rupees per borrower will be included under the priority sector, provided the interest rate charged to the ultimate borrower by the HFC does not exceed 2 percentage points above the lowest interest rate of the lending bank for housing loans. As regards the cooperative sector, scheduled urban cooperative banks, UCBs, have been allowed to undertake repo transactions in corporate bonds. Another important step relates to micro and small enterprises. The definition of sickness of these enterprises is modified to facilitate early rehabilitation of potentially viable sick units and to lay down a procedure for assessing the viability of sick units in the sector. Given the larger objectives of financial stability and keeping in view international best practices to ensure that banks have sufficient provisioning to buffer, the provision for restructured standard accounts is being raised from the current 2% to 2.75%. To address the issue of rise in NPAs and restructured advances of banks, and with a view to improving effective information sharing among banks on credit derivatives and unhedged foreign currency exposures, banks are being advised to put in place by end December 2012 an effective mechanism for information sharing. Any sanction of fresh loans or ad hoc loans or renewal of loans to new or current borrowers with effect from January 1, 2013 should be made only after obtaining and sharing necessary information. Unhedged foreign currency exposures of corporates are a source of risk to them as well as to the financing banks and the financial system. We are advising banks to put in place proper mechanisms to rigorously evaluate the risks arising out of unhedged currency exposures of corporates and price them in the credit risk premium. Banks are also being advised to consider stipulating a limit on the unhedged position of corporates on the basis of their respective board-approved policies. We're in the process of strengthening the regulatory framework for dealing with systemically important financial institutions, or SIFIs for short, which may come under stress and may require resolution. Accordingly, the government and the Reserve Bank are setting up a high-level working group to recommend a comprehensive resolution regime for all types of financial institutions in India. I have highlighted only a few of the development and regulatory initiatives. There are a number of other initiatives in Part B of the policy document. I urge you to refer to the policy document for all details. Before I close, let me note that the persistence of inflation pressures, even as growth has moderated, remains a key challenge. Of particular concern is the stickiness of core inflation, mainly on account of supply constraints and the cost push of rupee depreciation. Consequently, managing inflation and inflation expectations must remain the primary focus of monetary policy. A central premise of monetary policy is that low and stable inflation and well-anchored inflation expectations contribute to a conducive investment climate and consumer confidence, which is key to sustained growth on a higher trajectory in the medium term. Accordingly, over the past few quarters, monetary policy had to focus on inflation, even as growth risks have increased. As recent policy initiatives by the government start yielding results in terms of revitalizing activity, they will open up space for monetary policy to work in concert to stimulate growth. However, in doing so, it's important not to lose sight of the primary objective of managing inflation and inflation expectations. Thank you all for your attention. On behalf of the Reserve Bank, my best wishes to everyone for a happy Diwali. Thank you very much.
All right, so that is the RBI governor walking through the policy document for the second quarter